Let's welcome on board Satish Pillai, the MD and CEO at TransUnion CIBIL, joining us on the show right now to really give us a flavor of what's happening between lending patterns. Satish, good to have you on the show. Thanks so much for joining in. What are the primary cues from various lending segments, both in value as well as volume terms, based on the analysis of the latest quarterly data?
As you look at this data, it's important to kind of separate out what is unsecured lending, which is loans to finance, consumer durable goods, personal loans, those played in the private space, NBFCs, fintechs, and separate that from auto, two-wheeler, home loan, LAP, on the secured side. But I think the differences have been quite dramatic. So on the unsecured side, actually, the growth has still been very, very strong. We still see strong double-digit growth in personal loans, consumer durable loans. What's interesting is the new originations, or absolutely new people coming in looking for loans, that's growing at a very high rate, over 30%. From an amount standpoint, the ticket sizes are getting lower in India. That's a trend that we've been seeing for the last 3 to 4 years. So although that segment is growing, there's a high demand for it. It's loan for consumption. That includes credit cards as well. Balances in cards are up year over year for this quarter, and that trend has always been increasing. The revolve rates on cards have been pretty steady too. But the unsecured story has been strong this quarter again. Delinquency is still low. What's different though is the experience on the secured side, and we all know exactly what happened on the auto side, the demand shortage or the oversupply, whatever the driving forces, we've seen the pickup on the auto side being significantly lower than before. The impact because of the NBFC crisis actually has a spillover effect as well. So all in all, if you kind of look at from an amount standpoint, yes, the amount or the lending amount actually over the last quarter has probably been lower. But I think India has changed dramatically from lending landscape. I think it's more appropriate to start looking at number of loans given and number of new originations. That has a cost impact to banks as well, but also it talks truly in terms of inclusion. There are more people actually coming in, getting access to credit faster and cheaper. So I think for India, the dimension to look at, not just in terms of percentage of credit offtake, but number of people actually getting credit, and that's been rising.
Sure. But with credit access ease penetrating, the domestic population and around about 15% of the total being first-time users to credit, do you really see a risk of delinquencies come by?
A couple of things around that stuff, and I think traditional definition of financial inclusion talks to people who don't have credit. But here's the interesting fact, right? It's about 22, 23 million people applying for credit every month. So only about 15% have never availed of credit before or never asked for credit before. So that means that it's not just that brand new people to credit. Now it's a large number, 22 million. So there are people who are, enough people getting access to credit every month. But the bulk of lending is still to people who've already been included, as it were. But it's still inclusion in the sense that you're actually giving them credit in a very different fashion than those 3 lakh, 3-year, 10-year type of personal loans. Fintechs have gone down to 10,000 rupee loans. So it's almost like getting money when you need it for the purpose that you need it, and then you pay it back. So the dimensions have changed, right? From a delinquency standpoint, and you see that across the board on unsecured, still very strong, still very low. So we track two things. We track very early delinquencies as well, because you look at late delinquencies that show up in a P&L. They might look good, but there's a cost of collection that actually a lot of banks have to go through as you acquire more and more customers, right? Every customer is a finite cost in terms of collections. The amount might be small, but if you spend the same or use the same methodology to collect, your cost is always going to go up. So what we actually see is delinquency on the unsecured side still very stable, whether you see consumer durable loans or personal loans. NBFC's delinquency rates have always been higher than the private side. The private side, private lenders and public sector banks, they're tethered by CASA accounts that they're cross-selling to. The NBFCs tend to be a lot more open source. So by definition, you expect it to be higher. The question is more around stability, and still continues to be stable. Now, of course, the two parts that we actually look at that maybe the data doesn't directly show. So what's the cost of acquisition? As this grows, do you have the scale to be able to reduce the cost of acquisition as you grow your books, whether that's fintechs or private players? Larger players are better placed for that. And the second piece around collections. What's your collection effectiveness? What's your collection cost that you pay to ensure that the NPS are lower? Again, the larger scale enterprises probably have a better scale, and fintechs and all will have to kind of go through that growth curve to get to that point.
So will next wave of growth come from tier 1 urbanized areas? Do you see growth being fueled by smaller towns and cities and perhaps rural credit growth? Any specific geographies or data which is looking interesting?
The last 3 or 4 years, that what we've seen is the emphasis, especially if you look at the product type, right? So we're talking about financing consumer durables. So it's phones and TVs, smaller ticket size, fintech lending. It's actually been going a lot more semi-urban and rural. So the largest growth segments across everything. Every segment on the unsecured side is semi-urban and rural. In fact, if you look at credit cards as well, it's a great example because one extreme which is considered very urban. Now, 80% of the balances are all urban. That's kind of known, it's a large part of it. But the fastest growing segment there has actually been semi-urban, rural. Those are segments where credit card companies are actually reaching out, they're crossing into their CASA base or in partnerships with banks to kind of figure out how do you get card to the unguarded. So the growth has actually been diverse from a geography standpoint. It is no longer the large metros. In fact, that's not been true over the last 6-7 years. 7-8 years when India's revival from a retail credit standpoint started with gold loans and secured, it started going to much, much deeper geographies. And that trend has continued. And I think the growth has been fueled a lot more by the semi-urban and the rural setting in those areas where we've seen actually strong growth across unsecured and secured as well.
So where do you perceive the largest risk to the current lending sphere?
So a couple of risks, right? The risk is from within. So are you growing too fast? Are you not able to manage the book? Like I said, that depends on cost of acquisition and collection cost. And we see the larger players doing much better. And the fintechs, they are growing, they're driving a whole lot of growth in the economy. The big question is, how do they manage this from a profitability standpoint? How are they effectively able to manage the cost? Excuse me. And also being able to manage collections effectively. So that's the pressure from within, right? That actually has a balance sheet impact. And therefore, there's a cost of capital crunch, and some lenders might actually slow down because of that. We haven't seen that in a large extent, right? The influence from outside, that's a lot more material. But remember, because the growth has been on lower ticket size, the traditional definition of leverage and how much money you make and therefore how much debt you have might not be the right measure to look at unrevealed risk. So we look at things like velocity. How many times are you getting loans in the last 3 months? There might be much smaller ticket size loans. That might be 7 to 10,000. There might all be 0%. You might not even think of it as loan. But it is adding up in terms of the number of loans you're servicing. There's a cost for the banks, the NBFCs to be able to collect. So those are kind of the stresses that are from within. It's not necessarily leverage, but there is speed of it. And I think all banks and NBFCs are very paranoid about the slope of leverage and the speed of access to credit. So I'm comfortable in terms of the risk awareness of the industry there. The second piece is the impact from without, which is the macroeconomic impact, right? The liquidity crisis from an NBFC standpoint has definitely resulted in less credit being granted by NBFCs. On the smaller NBFCs have been impacted. We've seen them kind of drop off. The same thing on the HFC side. Major impact that is actually seen. So now these look contained on one element. You look at the entire retail industry and we can all congratulate ourselves. Overall, it looks fine. But I think the risk that I worry about is contamination effect. To give you an example, when auto is actually slowing down, if you see the delinquencies on the private side, not necessarily a private or public sector side, not growing up. They've been, I think, going up. They've been managing it very well. But the challenge that actually you will see in the SME side. So SMEs in the auto cluster, you're actually seeing stress there. And that stress is actually, they are good risk customers. From our score standpoint, saying that they're very, very low risk. But we see them migrating. And that actually happens when the real economy started slowing down. If there are supply side issues, or caused by lack of demand, or could be even because of oversupply, you'd actually see the MSMEs slowing down. When they slow down in clusters in areas, those geographies, even the retail lending at some point will start seeing contamination effect. Limited now. The scale of Indian lending is much, much larger than 10 years ago. But I think those are the things that I kind of worry about. How does the contamination spread through issues that we see on the MSME side? We get led out of recessions that led into recessions, if you will, by the small businesses. So that's the key thing to look at, not just them, but the effect that they have because they are individuals and consumers associated with any area or any company. And their payback in terms of consumer durable loans and personal loans, if that starts deteriorating, then you actually start having a more widespread ripple effect that you actually start seeing because of this slowdown.
All right. And where would you place India in terms of credit access? Are we where China was a decade or more ago? Like, where do you think we're headed in terms of credit adoption on a mass scale and financial inclusion?
Yeah, so a couple of ways to look at it. I think it's important to compare, and you talked about China. I think it's a good country to actually compare ourselves to start looking at where the runway of growth is. But the experience is slightly different in India. If you see from what type of lending actually happens and how much of it is point of sale, it's somewhat similar but different just because the experiences from India's standpoint are very different. The lending community is very, very different. But I think the similarity is more around what you need to unlock in terms of availability of credit, right? So the runway from an India standpoint, there's close to 600 million people in India who have got access to credit, at some point or the other, right? That could be 10, 20 years ago, they got a home loan and nothing else, got one loan and nothing else. Even there, they're probably exclusion of credit in the sense they might not get money when they want to. Remember, only 50% of people, when they apply for credit, get approved. They either get declined. We talk about the banking side being profitable because of it. The NPAs are lower, but there are a lot of people getting declined for credit for whatever reason. So there is an element of unlocking the credit demand for those individuals based on their need. And hardly ever a person has a need for a loan. They actually have a need for an end purpose. You need a phone, you need a home, you need a car. So I think the big runway of Indian growth is one going to be unlocked by product construct on the lending side. It's already happening. And I think for me, the fintech revolution in India is a lot more about how they're looking at the product construct more attuned to the need of the consumer rather than I have a 3-year loan. You use it for whichever purpose. You're trying to finance a vacation, then I can actually do that. You're trying to finance something for education, I can do that, or one-offs. That, I think, is the big change that's happening. And in terms of pure math, I think there are probably about 200 to 250 million individuals to unlock that organized lending has not got to. And how do they unlock it? I think part of this is going to come down to, as I said, around the products that actually matter. Why do women borrow in microfinance group and only 10% of them migrate into banking? Because the product construct is a lot more attuned to them. They would rather borrow in groups, rather smaller amounts, rather smaller tenure. So how do we actually figure out that behavioral bias and get to that? Gives us possibilities from a runway standpoint. So one caveat though on a runway. A runway, like I started this conversation as well, we should not look at amount as the runway because you have to kind of figure out what the need is. It's more in terms of numbers, the number of individuals that you can reach when they need access to credit. I think there's a huge runway. From that perspective, probably similar to China in terms of lending and payment kind of becoming very blurred. That's the evolution that we actually see, but a lot of work for all of us to do to make sure there's data available for us to make faster decisions and understanding of consumer behavior as well.
Okay, and while financials form a significant chunk of the market cap, given that the majority of Indians are yet to enter the formal credit system, how large an opportunity or how large a growth story awaits for Indian financial companies?
No, I think, as I said, there is a runway to growth for all these lenders, from the largest lenders to the smallest one. I think it's not as if Indian opportunity is kind of tapped out. It's not that even people who have access to credit today, so let's say people who've got loans before, 600 million, it's not that there is more not to untap. You have to be careful in how you do it. There's macroeconomic factors that actually play in line to allow us to grow. But look, in terms of new originations, and I keep going back to that rather than just amount, because amount gets a little muddy. Right? So you see 12 to 18% growth in credit and you think it's lukewarm. You see number of new originations, that growing at 30, 35%. That means that there is a whole lot of activity trying to make sure that you can reach out to consumers. Ticket sizes must be much, much smaller than before, but probably the right way to get to individuals. The debt burden then is much lower. There's a chance to actually sustain this run a whole lot longer. But all this, as I said, depends on effective management from a cost of acquisition and collections cost. And of course, the macroeconomic piece. And I think if the small businesses and the small business industry, the micro and small, any stress on that will have at some point a contamination effect. And we have to keep a very careful eye, not just in terms of who you lend to, but where you lend to and their affiliation with small business clusters that actually might be failing. So the sustainability requires a whole lot of a circular reference, if you will, around the small business as well as the consumers to be able to sustain both sides of it. There's, I think, a great story over the next 5, 10 years for this market.
All right. Thanks so much for joining us this morning and taking us through all of the latest ongoings, Mr. Pillai. Do have a good day going ahead.